Bulk drug manufacturer Bajaj Healthcare delivered a blockbuster FY21, beating expectations on all counts. Following the strong set of earnings, the stock price nearly tripled in the last 12 months. The management is optimistic about the growth outlook as the robust drug pipeline would continue to propel earnings in the coming years. Revenue in Q4 FY21 rose to 132 crores, up 12% from last year. Bulk drugs, the largest business segment, grew 13% with sales coming in at 127 crore rupees. In contrast, formulations and another weak quarter with segment revenues witnessing a 17% degrowth YOY. Higher contributions from value-added products and benign input cost aided expansion in gross margins YOY. While revenues declined sequentially, margins increased quarter-on-quarter, with operating margin rising nearly 180 basis points to 26.5%. At the end of Q1, management had guided for 16 to 18% operating margins with 700 crore rupees in top line in FY21. While the revenue for the full year came in slightly lower than the guidance, margin performance far exceeded expectations. Over the next 2 to 3 years, management is targeting a top line in excess of 1,000 crore rupees, which equates to a CAGR revenue growth of around 15 to 20%. Bajaj Healthcare continues to progress well on its business growth strategy, increasing its product pipeline and expanding manufacturing capabilities. The business has a lot of potential for growth over the long term as it continues to invest in research and development to enhance its product offering. In the last 18 months, the company acquired 2 sick units for a total consideration of 90 crore rupees. The company is in the process of revamping and upgrading these facilities and expects these units to commence commercial operations over the next 2 quarters. For FY22, the company does not have major capex planned and will primarily be focusing on driving growth through new product launches and ramp up of the acquired manufacturing units. Historically, Bajaj Healthcare's operating margins have been in the mid-teens range, but the margins for Q3 and Q4 have been exceptionally higher, around 25%. However, increasing competitive pressures, commencement of new manufacturing units along with depletion of low-cost inventory could result in some tapering of operating margins. Going forward, the growth on the top line is also likely to moderate owing to base effect. The onset of the pandemic resulted in an unprecedented spike in demand for certain products. CH base used in sanitizers, disinfectants and vitamin C APIs. With time, the demand for these products has come down, but the company has recently introduced new drugs for the treatment of COVID-19. The new launches comprise Favijaj, Ivejaj Posaconazole, which are helpful in treating patients suffering from influenza and COVID. Moreover, the company is working on additional molecules and formulations in the pain management, anti-malaria and anti-diabetic segment. Generic drug market remains a competitive business due to high working capital requirements and frequent government interventions. However, Bajaj Healthcare has been able to scale its business operations despite the fragmented nature of the industry and competitive market dynamics. The stock of Bajaj Healthcare has undergone a swift re-rating in the current bull market. However, investors can look to accumulate the stock on dips as the business prospects appear promising, the management is executing well, and the stock offers decent upside potential over the long term.